Hello, everyone. Welcome to today's program on the top financial challenges for startup companies. My name is Steve Hovland. I'm a certified public accountant as well as a certified forensic accountant, and I am the founder of Delegate CFO. Today, we're going to go through the top issues that startups and growing companies experience in their particular companies. Now, a couple admin items. This webinar is being recorded, so if you miss anything as we're going through this, we will have a link to the replay, and the replay will also be hosted on our website. Also, we will be sending you the slides at the end of this particular program. Also, if you have any questions as we go through this process, please feel free to put them into the Q&A feature in Zoom. So let's go ahead and get started on our particular program. So as I mentioned, today we're going to do the top startup financial challenges and what they see on the particular, and what we actually see on those. And so for today's agenda, obviously we're going to talk about mastering your cash flow and runway. And the runway is when you ultimately run out of cash, and that's the best way to think about that. The number one mistake founders make, and again, this is from our experience on what we've seen on founders and growing companies. Now, there may be other items that may be considered the number one mistake, but these are what we predominantly see as we've been in this business for a while. Tools for forecasting and budgeting, navigating fundraising with confidence, and not only just fundraising, a lot of times with talking with your investors and potential investors, the key metrics that those investors care about, and then scalable, founder-friendly financial systems. In other words, we want to make sure that your financials are user-friendly for you, for your particular industry and or company. Now, first item, mastering your cash flow and runway. Why does this matter? Well, ultimately, you want to be able to outlast your runway because that means your survival. In other words, if we think about it another way, you want to make sure you don't run out of cash. Because what a runway is, in the very high level terms, is it's when you ultimately will completely run out of cash in the business. And so that's a better way to think of the runway is you want to extend that runway as long as possible so that you can keep functioning as a particular organization. Now, how do you master this? Well, you need to be able to model your cash inflows and outflows monthly. Now, one of the things you have to understand is before you can even do your model on your cash inflows and outflows, you need to be able to develop a budget. And this is one of the keys for any company, whether you produce a product or do a service, you have to have a budget in place. You know, that's very paramount for your company. And so when you go through and put your budget together, you're going to say, we're going to have X amount of sales in each month. We're going to have X amount of expenses in each month. And then you're going to come up with a net income number. Well, when we do the cash flow part, the cash inflows and outflows, that doesn't always necessarily match up to your budget because your budget is really on what's called a GAAP basis, generally accepted accounting principles. So in other words, you have your expenses, your revenues that you've earned at that point in time, and your expenses to come up with your net income. However, a lot of times that revenue is revenue that you've earned but not necessarily collected. And so as your the key part to understand that is we have to have that budget because we need to know what we're going to be selling and what our projected revenues are going to be. But then we need to convert it into a cash basis so we understand when we're going to run out of cash or are we going to run out of cash. So case in point, you sell your product. Let's say you sell a physical product and you budgeted $100,000 in revenue in July. But because of your terms, you're not going to collect that until 30 days, or your customers have 30 days to pay. So even though your income statement shows you have $100,000 in revenue, your cash that you've brought in or your cash inflows may be half of that. Maybe half of those customers have paid, and the other half aren't going to pay until the next month. And so that's one of the key differences is when is that cash truly going to come in, and when do you have the cash go out? So Again, you need to have your budget together because we need to know what our sales are going to be in August, September, October, November. And then from there, we need to calculate what's the expected cash inflow. And then, of course, then we do the expected cash outflow. And we combine those to determine are we going to have negative cash or positive cash flow for those particular months. One of the keys you need to understand is on that cash inflow and outflow, you need to also incorporate any inventory purchases. Again, when you purchase inventory, you're not just purchasing enough for the next product run, you're purchasing large quantities of inventory so you can make multiple product runs. So that needs to be built into your cash model. Then you need to track your burn rate and forecast your runway regularly. So burn rate is, there's two aspects into burn rate. There's the gross burn rate on the total expenses that you're incurring, and that's how much you have to pay every month for those expenses, or yeah, for the expenses. And then there's the net burn rate, which is your expenses less any cash that you're going to get in for that particular month, i.e. sales that you collected. And so you need to know how much cash you're burning. Obviously, ultimately, we want to get to the point where we're not burning cash net. We have a net not burning cash. Um, but for our purposes, for startups and growing companies, we need to know how much cash we're burning monthly. And if possible, you want to do a daily cash burn as well. The reason why we want to do that is a lot of times with your budget, you break your budget down on how many sales, how many units you have to sell per day. Because sometimes that makes it easier to wrap your mind around. Is it logical that I can sell 10 units per day when normally I can only sell 3 units per day? So that's also why you want to break down your cash burn is not only know what your monthly cash burn is, but what's your daily cash burn? How much cash are you burning per day? So that gives you kind of an idea as to, okay, we're burning, let's say, $1,000 a day, but we're only bringing in 500 a day. How do we identify that? How do we fix that? And that's really the next step is you want to identify your cash gaps early and take action fast. Reason being is you may have a gap in, say, July, but you're not out of cash. So, you may not react to that. But that's why you do your runway to see, okay, when do I run out of cash? If you say you're going to run out of cash in December and we're currently in July, that gives you enough time to make adjustments to your cash outflows or inflows to compensate for that. Because the longer the time period you have, the easier it is to make those modifications. If you get to, say, November and you haven't changed anything, trying to make drastic cuts to get through December might not be feasible or doable. So, and then, of course, pro tip, use cloud-based tools for live updates. There's a lot of tools out there that allows you to synchronize your accounting records into either a dashboard or even a cash flow indicator. And so utilize that information if you have it available. One of the questions we have, how do I accurately calculate and extend my runway with inconsistent revenue? Well, that's not going to be any different than mapping out revenue linear. You're just going to know or just have to understand that you're probably going to have a lot of peaks and valleys. So if you're inconsistent revenue, say July, you have 3 jobs that you did and you got the revenue on that, and then August, you don't have any jobs, and then September, you got 2 jobs, your cash inflow is obviously going to be higher those months, so you're probably going to have a positive cash burn on those months. And then the other months you'll have negative. So you need to smooth that out and look at not only the respective months, but how does that flow through extending out? Because again, we want the runway to keep going. We don't want to outlast our runway. So even though we may be inconsistent with our revenue, we need to make sure we consistently map that all the way out. That was a good question. Uh, Next item. So the number one mistakes founders make, and of course, how to avoid them. The biggest mistake is just not knowing your numbers. Because as a founder and growing business, you get very, very focused on growth. You want to go out and get that new customer or get that new job or, get in with Walmart to sell your respective products, whatever it is, You're very, very focused on building growth in your company. However, a lot of times founders don't pay a whole lot of attention, or as much attention, I should say, to their margins and how much cash they're burning. And so it's very important that you understand what your margin is. And recall from the previous webinar, gross margin is sales minus cost of goods sold equals your gross margin. That number at a minimum has to be positive. That number is not positive, it's zero or negative. It doesn't matter how much you're going to sell, you're not going to have any positive cash inflow. And same thing with the burn, understanding how much cash you're burning each either day or by month. So that gives you an idea as to what kind of sales do you need to generate, what kind of line of credit do you need to get, what have you. Um, Another mistake is financial blind spots that will cause a surprise crisis. And a lot of times, obviously, if you're selling a product that's at a loss, that's going to be it's going to show itself very quickly. However, one of the big blind spots that happens, especially with a growth company, or even a mature company that's experiencing rapid growth, is when you sell your respective product on credit. And by credit is the customer doesn't have to pay for 30 days. You have rapid growth. So if you just think of a bar chart, you've got rapid growth going up at an angle, and your net income is going up because you've got those sales, you've earned that revenue. However, you're not collecting that cash until 30, 60 days down the road. However, with any growth, especially with products, you have to bring in more inventory. So if I've got sales and they're going up at an angle, 45-degree angle because they're just rapidly growing, and I'm having to constantly bring in more inventory to meet that demand. So more and more people want, this particular unit. And so I'm having to bring in more raw material. I'm having to, have the manufacturing plant work overtime. So that's all cash outflow that I have to pay for right now. But those sales that you're doing, you're not collecting those till 30, 60 days. And so there becomes this disconnect between how much cash you have to do outflow to meet the demand for, to bring the product in, pay for labor, etc. And then the other side is the sales, you don't get those sales collected until significantly later. And so that is one of those unusual blind spots that as a founder, you're looking at your income statement, you're making all sorts of net income. However, you have no cash. And it's because of that particular issue. And again, this even happens with mature companies. You have a mature company that's, their sales have been kind of steady, for quite a while. Then all of a sudden they have a hot product everybody wants, and then they have to ramp up everything, and they incur the same, or they experience the same aspect of that. So that is one of the big blind spots is when you have rapid growth, a lot of times, even though you have net income, you actually will have a negative cash flow for several months, and sometimes it takes 3 to 4 months to flip over. Once your sales start to level out, then your cash flow will start catching up, and then you won't necessarily have that issue per se. Now, how do you avoid this? Establish regular, accurate reports. And this is just fundamental accounting. You need to make sure you have income statement, balance sheet, and a statement of cash flows. Now, a statement of cash flows is very important, and unfortunately, there's quite a few accountants out there that struggle producing the statement of cash flows. However, it's a very key instrument in analyzing your financial statements because it gives you an idea as to the cash that's coming in, is it coming in from operations? Is that positive? Is it coming in because you're just taking out debt or bringing investor money? It gives you kind of a better idea, but that is a very important report. Then obviously you want to make sure that those reports are accurate. So with our particular CFO firm, each of our clients, we do what's called a mini audit. So, and what that entails is the balance sheet for each of those companies, we will tie out, and it's called tie out, will prove the significant numbers on the balance sheet are supported by external documentation, such as the income statement, or I'm sorry, the cash is supported by a bank rec and a bank statement. So that proves out that number. The accounts receivable ties out to an AR subsidiary ledger, and that AR subsidiary ledger is correct, and there's no unusual items in there. So we go through and prove it, because if the numbers are not correct on your balance sheet, you're going to have something incorrect on your income statement, which then causes you either to make a bad decision or not realize you have more cash outflow, etc. So you want to make sure those reports, at a minimum, you want to make sure your balance sheet is accurate that you're using each month. Obviously, review these key financials monthly, preferably timely. Sometimes you'll have issues where if you do e-commerce and you're waiting for a lot of the revenue to synchronize back into your accounting system, and that might not happen for, say, 5 to 10 days, then at that point in time, you should get your financials. Get them tied out, get going. If you do your financials monthly and you're tying up the balance sheet monthly, getting the next month won't be that big of a deal. Now, if you haven't done it for a while, the first set of financials may take longer, but you want it timely and preferably about 15 days, 10 to 15 days after month end, depending on if you're waiting for certain transactions to synchronize in. And obviously, ask questions and partner with a financial pro. Not only can you ask questions of that particular individual, they don't necessarily always have to be financial related. So some of our CFO clients, when we meet with them weekly, we sometimes will delve into areas that are not necessarily our expertise, but will give some insight as to how we view that respective data, such as the ROAS on the Amazon sales. We may not have the SEO background, but we'll start analyzing and work with them. And sometimes we can be that sounding board for questions as to the financials, sales channels, what's the effect on, if you do move into another particular sales channel, what's that effect? So use those partners and always bounce off questions, because sometimes just a simple question and response could trigger an idea within your particular company. Now, tools for forecasting and budgeting. Are simple spreadsheets good enough? Well, yeah, for the most part, they are when you first start out. Because when you first start out, you need to be able to map out what it is you're selling, what are the costs, what are the channels, what are are you bringing in the inventory, the raw materials from overseas? There's a lot of variables that are built into your business. And so using that spreadsheet will allow you to go through and start analyzing what it is I want to analyze, what particular costs are unique to my particular company, and whether it's a particular cost that comes in that gets allocated to the product, or if you're using a sales channel that they take a 40% haircut. A lot of those different variables you need to build into your overall spreadsheet. First for your budget, then for your forecast, and then of course for your cash flow, for your cash in and out. Um, And from there, as you're building that, that'll obviously give you a better idea as to what kind of software you're ultimately going to want. Now, when you first start up, you need to have accounting software. That's kind of hands down, you must have some sort of accounting software. Please do not use Excel as your accounting software. That is not appropriate and could cause you major headaches down the road. Use something like QuickBooks. Even if you just do the very basic package for QuickBooks, track that data in there. Same thing, you can use Xero or QuickBooks. They're both very comparable. But start using those softwares. And the use of QuickBooks, you can use QuickBooks for quite a while for your company as it grows. Don't feel hesitant or trapped that you need to right away be able to go in and buy the high-end $100,000 software. You probably don't. Because again, think back to our spreadsheets. We're trying to determine what it is we're going to ultimately want in our software. Because when we get to that point that we're going to move up from, say, QuickBooks to a larger software package such as ECI, we want to know every little bit that we want to make sure that's in that particular software package. So obviously, regularly update your forecast based on real results. And what this means is, so when you set up your budget at the beginning of the year, and right now we're in the 1st of August, so let's say we need to update that budget for January through July. So you go into that budget and again make copies of these. Keep your standalone budget and then make a copy, and then update for the actual results. So your actual results for July for your income statement side are X. And then from there, you can see, okay, here's my actuals, here's what I was budgeting, here's where I'm ultimately going to get. Because again, this is going to come all the way back into our cash inflow and outflow because we need to identify here's what we were budgeting. Let's say for July we budget 100,000, but we only had 50,000. We put in the actual results, but we also want to do a budget to actual to say, okay, is our budget off? And then we can analyze, August, September, October to say, was that just an unusual month in July, or is this a trend we need to adjust for? Because again, that's going to go back into your cash and into your runway. And of course, set realistic budgets. You know, everybody wants to, start up their business and make millions of dollars, but make sure it's a realistic budget. So if you're producing a product and you want to budget $1.2 million in revenue for the year, which comes out to 100,000 a month, is it feasible at your current state to be able to produce $100,000 in revenue, however many units that is? Do you have enough inventory on hand to be able to do 100,000 in revenue? Do you have enough space and materials and workers to be able to do that? So make sure your budget is realistic. Again, this is all going to go back into our cash flow. Now, navigating fundraising with confidence. Now, this is obviously if you're a startup growing business, odds are you probably had to meet with an investor and pitch your company. And there's also odds that you pitched your company for investors and they didn't want to. Be prepared for any kind of conversation you have with those investors for your fundraising. Obviously, you're going to know your story. This product, super great product, we love it. This is what we think it's going to do. But obviously, you want to know the other parts of that. What is the cost of that particular product? How many SKUs do you have? What's your margin on those SKUs? How much inventory do you need to bring in for each of those products? Build your robust models. Budget it out, forecast it out, and then do more or less. A lot of times you hear it called stress test, and it's also called what ifs. You know, Build that out and say, what if this particular SKU, we don't have 100 units per month on sales, we only get 25 units per sale. What happens to that? What's the cash flow impact? So you need to be able to understand, obviously, it goes all the way back to, you need to make sure you have accurate records, you have timely records, and then you're updating based on reasonable budgets. And so then from there, you're going to go ahead and make sure that you're calculating out your stress tests, say worst case scenario or what if scenarios, so that you have a firm idea. Because ultimately, what investors really want, they want reliable data. Again, making sure your balance sheet is 100% correct. And then from there, it should trickle into your income statement. And so they want to know, is this data correct? Do you have logical projections? Not just pie in the sky projections, but okay, this is what we thought. Now this is where we see the trend going. It's going to go to these particular items. We're going to have more sales on the website versus Amazon, et cetera, et cetera. And then from there, you need to have clarity on use of funds. And this is where your cash runway comes in big. You can do a budget for your income statement, and that, again, that's very important. But when you're talking to an investor, they not only want to see that budget, they want to see your cash runway. And so that is key to understand. Okay, here is, what we're projecting for net income. And because we're projecting huge growth, come September, we're going to need to buy, this much inventory to then meet the demand for, say, November, December. And so if you have both those reports and you have your cash runway mapped out, you have a firm clarity on the use of those funds that the investor is going to bring in. So that's why you want to make sure you have reliable data, a budgeted income statement and balance sheet, and your cash runway, your cash net inflows and outflows. One of the questions here is, how should I prepare financials and projections if I'm getting ready to fundraise? Well, again, first, make sure your balance sheet is tied out. It's tied out to the respective source documents, bank rec, AR subsidiary, AP subsidiary, et cetera, et cetera. And then make sure your projections are accurate, and in your projections, especially under cash flow, you're bringing in anything that normally wouldn't hit the income statement right away, which is usually going to be your inventory and equipment if you have to buy equipment. So make sure you have that all built into there. Now, the metrics that investors really care about, and by investors, I'm also indicating bankers into this particular slide. Obviously, these are just some of them. Critical for SaaS or tech. Your customer acquisition cost, lifetime value, churn, unit economics. If you have a product, is your margin, cash conversion cycle, your runway. What you notice about those, and those are just a few metrics. There's quite a few metrics out there, but these metrics, more or less, are another way of thinking of a financial lever. So you may have heard that term used out there that, the financial levers of your company. They're used, or that term is used because these particular metrics, and these ones on the screen, are ones that you can adjust and manage these metrics, and it actually will increase the net income of your company or cash flow of your company. And so that's why they're important, is because a lot of times these metrics aren't necessarily financial metrics. There are other metrics out there, they're non-financial metrics that allow you to manage the inflow or either in cash inflow or reduce outflow of the respective company. And so that's why these are very important, and why investors and bankers really care about these ones is, are you tracking that? How do you match up to your competitors? And how are you using these metrics to really manage your company? So one of the tips is, obviously, you want to build and track these monthly. And again, make sure whatever metric you end up using is beneficial. Case in point is there's some accountants, CPA firms out there that they love to use just a textbook ratio, such as current ratio. Now, the current ratio is current assets over current liabilities, and you get a number. Obviously, you want that number to be one or more. That's a great ratio. In our firm, we call those warm and fuzzy ratios because yes, it's a ratio, and you want to make sure that you have a positive, you want more current assets than current liabilities. But at the end of the day, what does that um, metric actually do for you to manage your company? And the answer is it doesn't really do a whole lot. It just gives you a calculation. You just you just did a mathematical calculation, but it doesn't really help you manage your company, manage the cash inflow, manage the churn rate if you're in the tech industry. So make sure whatever ratio and metric you're using, it's something that can be utilized for your company, whether it's just tracking the respective AR aging or the cash outflow on suppliers. Whatever it is, it's got to be something that's beneficial to your company to help you manage your company. Now, setting up scalable, founder-friendly finance systems. Eventually, you're going to move beyond spreadsheets. Now, as an accountant, I use spreadsheets all the time. But eventually, in your company, you're going to move from tracking your budget, tracking your forecasts and spreadsheets to bringing it into a software. And again, remember when we talked about earlier is when you're setting up your budget, the first time you're setting up your budget and forecast, you're going to determine or realize you have a lot of variables built into your respective budget. The respective SKU, each SKU may have a different gross margin, may use different materials, may have different sales price type situations. So you have a bunch of different variables built into your spreadsheet to get everything to work and flow through. Now, when you're doing the upgrade, you want to be able to have that software that allows you to do that same aspect without a whole lot of data input. And so that's why I say when you build that spreadsheet, you then know what you're going to want in your accounting software or your ERP software is how do you want that to integrate back and forth. Um, and again, make sure you choose a system that you'll actually use and not avoid. Reason why I put that in there is I have seen a situation where a manufacturing company had been using a fairly high-end ERP system, but when it first came online years and years ago through an older owner, the company wasn't really utilizing the full aspect of that software. They were probably using about 10 to 20%. And again, part of that was probably because they just didn't understand everything, or they just didn't want to go, or again, they were avoiding using it properly. make sure whatever software you get, you're using it to its full tilt. And again, you're going to use your spreadsheet that you develop to say, this is what I want into the software, and this is what I want it to do. And so then that actually makes it easier when you're, getting pitches from different software companies to find out, can it do X? Can I input a change in the value for this particular product, or can I change where this product's getting sold? Say it's getting sold on Amazon and they take a 40% haircut. You know, can I drop that in and it automatically calculates out on my budget and forecasts and how many more units I have to build, etc. So that's ideally what you want to be able to have. And again, automate your bookkeeping, payroll, whenever possible. Most people use outside payroll service anyways. So make sure you have that automated within your accounting system. And very important, create um, your standard operating procedures for your finance processes. Again, this may seem overkill at first when you're first building your company, but eventually when you get to year 3, 4, 5, a lot of the people that started with you have either retired, moved away, been terminated. They're no longer with the company. And so by the time you get to year 3, 4, and 5, you've kind of, ironed out all the bugs and you know how you want your particular company to run. When you bring in that new person, if you don't have standard operating procedures in place, they may deviate. You may be thinking, okay, everything's running smoothly. I'm going to go over here and sell my product more, and then everything just goes off the rails. And so that's why you want to have those processes in place. And a question here: when is the right time to hire a fractional CFO versus an accountant or bookkeeper? Well, you can really hire a fractional CFO. Technically, you can hire at any point in time. But if you're just starting out, you can hire a fractional CFO to come in and do one-time projects for you, such as help you develop an actual budget, help you develop a forecast. And then as you start growing, um, regardless, you always want to have an accountant or bookkeeper in place. You want somebody doing the data entry for you. But as you start growing, then at that point in time, if you start having higher levels of complexity, more products, more channels that you're selling at, then you should consider bringing in a fractional CFO. The other aspect is if you bring in investor funds. So you went out to an investor, right in, say $1 million, definitely would suggest you bring in a fractional CFO as soon as you get that money. Because again, the investor wants accurate data. And as a startup growing company, you're going to be out there doing a lot of selling. If you're having to go through and tie out all the financials and do all the financial statements yourself, or have to go back through and check the work of the bookkeeper, that's taking time away from you building your company. So that's why it's very important. Again, that investor wants to have accurate data and they want to have accurate projections going forward. And so that's why you want to bring in that CFO so that they don't come back and question you as to on the financial statements and then possibly pull the funding, which would be a very worst case scenario in there. Now, a couple examples that we've encountered. Startup A, we were able to extend the runway by 6 months with proactive cash management. And again, this was one of those where we looked at, we did calculate the runway out. It was actually obviously past 6 months. And we started realizing that with these certain expenses, these were R&D expenses, that they didn't necessarily have to do those expenses. They could put those off because they had enough SKUs in place. So we determined that, hey, we can back off on these expenses. So if we do that, then their runway got extended. And then also there were some other expenses that we realized we can push these expenses, or some of them we just didn't need anymore. And so then it was easier to be able to look at those financials. But again, if we hadn't taken the time to go through that, we would have burned through the cash a lot faster than what had been originally thought. Now, Startup B, we were helping them with a Series A after strengthening their KPIs. Again, this went back to making sure your KPIs are relevant to your business. Again, you don't want to go through and put in a current ratio if that's not going to help you build your company. And so with this particular company, When we went through it, we determined what were the ones that really helped manage the company. And from there, when we went, when they went to the Series A, they were able to demonstrate these are the KPIs we're tracking. And in this case, we happen to have some industry KPIs on some of those. And so it made it better because we were able to show that, yes, we're managing it, this is where we're at, and this is where we're going. And then Startup C, technically, this is a misprint. It really is a growing company. They avoided a cash crisis by catching a cost overrun early. In that particular situation, they had developed a budget for a particular product, and they were doing a budget, they were doing a product run. And on that particular budget, let's just say it was 100 hours to go through and make this particular product. When they got done, we noticed that the costs were, the hours, let's just say they're 120 hours. So they had a cost overrun. So they had hours overrun, which not only you have labor, you have overhead getting, hitting that particular product. And when we went through, we determined there were errors in the actual ERP in the BOM report. And so we were able to catch that and determine, because ultimately what was happening is more raw materials being put on the product that didn't really need to be there. And so we were able to analyze, we caught those cost overruns. And then also, obviously, there were some efficiencies in there in place. It wasn't just material, there were some efficiencies that we were able to determine. And again, once we were able to catch that, that allowed the cash flow to flow into the company correctly. So now let's go into the Q&A. We've received some of these questions. First question that came up: how do I avoid financial blind spots as my startup grows quickly and adds complexity? If you're not going to engage a CFO, whether you do a fractional CFO or in-house CFO, then you need to take time and map out, especially if you're growing quickly and adding complexity. So I'm assuming complexity, you're adding a new division or a new product. You need to map out, because usually it's going to be sales that we're talking about. You need to map out how much inventory, if you're doing a product or if you're doing a service, how many new employees do you need to bring in at that level? Say like it's a accounting firm, you have to bring in staff accounts. You need to map out how many of those you're going to need and what's the ultimate cash outflows. Because a lot of times the financial blind spots are usually going to be negative cash or a lot more cash outflow than you're initially anticipating. So make sure if you don't bring in a CFO, you start mapping out everything related to those new growth or complexity. What are some warning signs that my financial systems aren't scalable and need upgrading? Usually, the first warning sign is you're spending a lot of time doing data input into your system on something that probably should be automatically syncing in. So, case in point, I've seen a manufacturing company that they had an ERP software, but they didn't buy the accounting software add-on for this particular vendor, and so they had QuickBooks, which was fine. The problem they ran into, or they started to run into consistently, was the IT guy built kind of a bridge between the ERP software and the QuickBooks so that it would sync in. However, a lot of times, over several months, new products in the ERP system weren't syncing in correctly, or we were getting duplicates in there. And so the accountants were spending a lot more time just trying to get it to fix itself or get it fixed in the accounting software. And because they're spending all that time on that, they're not getting the financials out, they're not getting cash flows out, so on and so forth. So a lot of times, if you start having to spend a lot more time on something that probably should be automated, that's when you probably need to start upgrading your respective software. And again, if you're in the manufacturing world, an ERP software that does both the BOM side and the accounting side are probably the most ideal. And same thing with even just software. How do you do your calculation there? How do you do your respective product? And how do you get the payroll and then into the accounting software? You want to try to get all that linked back and forth. And then last question, what's the best way to track cash flow without a finance background or team? Ultimately, first you need to make sure you have a budget. You've got to have a budget because that is going to determine what your cash flow is in the future. Because keep in mind, we are more concerned from cash flow as to what the inflow and outflow is going to be, the next month, 2 months, year down the road. But you can't do that calculation if you don't have a budget. So you've got to get a budget together. And again, you can use Excel, that's perfectly acceptable. And then once you determine, okay, how many sales am I going to have? How much inventory do I need to order? How much expenses, operating expenses am I going to have? You can start breaking that down. And then my recommendation is you at least monthly go back and say, okay, for July, I was expecting to have, a net inflow of cash of $10,000 and I had negative 30. Okay. Why was there that difference? What did you not build into your model? And then from there, update your model and go forward. But again, if you're not going to have a finance team on there, that at a minimum, you've got to have a budget and you've got to have that cash outflow. So we're running close to the last bit of our time. So if there's any more questions that come in, please feel free to shoot it into the Zoom link. Or if you want, you can go ahead and email me. I can be contacted at steve@delegatecfo.com. And as well as you can also find out more about our company at delegatecfo.com. And again, the recording and materials of this webinar will be sent out not too long after the webinar. If you are watching this on replay and you would like copies of the slides, please email us and we will get those to you as quickly as possible. And again, thank you for attending this webinar and I hope you have a great day. Thank you.